Hello class, this is chapter 10 for accounting 200. We're looking at liabilities, current installment, notes, and contingencies. So this is a nice chapter to look at. So here we go. So these are the learning objectives. Describe and illustrate current liabilities, including those related to accounts payable, accruals, notes payable, and current portion of long-term debt. Describe and illustrate the accounting for payroll liabilities. Describe and illustrate the accounting for employee fringe benefits, including vacation pay and pensions. Describe and illustrate the accounting for installment notes. Describe and illustrate the accounting for contingent liabilities, including product warranties. Describe the reporting of liabilities on the balance sheet. Describe and illustrate the use of quick ratio in analyzing a company's ability to pay its current liabilities. So if you're a small business, you'll probably, and if you have employees, you'll definitely take a look at objective 2 and 3. Not really notes. These are for larger companies. So if you're a small business, you can take a look at those objectives. So current liabilities: when a company or bank advances credit, it is making a loan. A company or bank is called a creditor or lender. The individuals or companies receiving the loans are called debtors or borrowers. Debt is recorded as a liability by the debtor. Long-term liabilities are debts due beyond 1 year. Current liabilities are debts that will be paid out of the current assets and are due within 1 year. Accounts payable transactions involve a variety of purchases on account, including the purchase of merchandise and supplies. Accrued liabilities reflect an obligation to pay current assets in the future. Accrued liabilities normally recorded at the end of an accounting period as part of the adjustment process. For most companies, accounts payable and accrued liabilities are the largest portion of current liabilities. So short-term notes payable. So here's how we would account for this. This is a 90-day 12% note for $1,000 dated August 1. So for a $1,000 overdue account, the entry to record this would be account payable 1,000, notes payable for 1,000. So issued a 90-day 12% note on account. So that's how we would record that. Now, so when the note matures, the entry to record the payment of 1,000 plus $30 interest, which was 1,000 times 12% times 90 over 360, because we're only accounting for the 3 months. So that's why we're doing 90 over 360. So notes payable of 1,000, interest expense of 30, and then cash of 1,030. So we're paying this paid principal on interest due on note. Okay, so we're the ones paying this note payable. Short-term notes payable: each note transaction affects a debtor, borrower, and a creditor lender. So here's some examples of how we account for this. So again, inventory, accounts payable, this is the borrower, this is the creditor, and don't forget this goes as cost as goods sold and inventory. Let's see, this is going to be account payable, moved it to note payable, same thing, note receivable to account receivable, and then over here where it looks like we're collecting, the borrower is collecting, the creditor is is receiving it. So it goes in as revenue. Over here it goes in as an expense. So just keep those in mind as you look at this. This is a borrower, this is the creditor. So a company may also borrow from a bank by issuing a note. Okay, so here's a note issued by First National Bank, $4,000, 90-day, 8% note to the bank. So we're gonna go cash and then note payable, 4,000, issued a 90-day note, 8% to First National Bank. So on the due date, December 18th, Iceberg Company owes First National Bank 4,000 plus interest of $80. Again, 4,000 times 8% times 90 over 360. So we're doing that specific length of time. So we'll go 4,000 payable, interest expense of 8, and then cash of 4,080. Don't forget, this is the person paying it. So notice the cash is being deducted. It's being credited, okay? So if we were receiving the cash, we would have a debit of cash. This would be probably reverse. Actually, it would say revenue, not an expense. So this is paying it. Short-term notes payable. In some cases, a discount note may be issued rather than an interest-bearing note. A discount note has the following characteristics. The interest rate on the note is called the discount rate. The amount of interest on the note called the discount is computed by multiplying the discount rate times the face amount of the note. The debtor or borrower receives the face amount of the note less the discount called the proceeds. The debtor must repay the face amount of the note on the due date. So short-term notes payable. So here is a carry company issued a $20,000 90-day discount note to Western National Bank. The discount rate is 9%. So the amount discount is $50, and that was 20,000 times 9% times 90 over 360. So then that's how we get the $50. So then we'll go cash received of $19,550. Oh, notice there's that discount of $50 right there, and then interest expense of $450, and then notes payable for $20,000. So this one we're receiving the payment, or their company is receiving it. We're doing the books for them, and then this interest that will be expense, and that'll go to the income statement. Other than that, the others are balance sheet accounts. Short-term notes, so notes payable, so there's a discount on the note, so then notes payable will be 20,000, cash will be 20,000. So this is paid note due. Okay, this is, so if the cash is being decreased, that means we are paying the note, a note. Current portion of long-term debt. The current portion of long-term debt, such as the current portion of installment notes, are reported on the balance sheet as a current liability. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. Installment notes are often used to purchase property, plant, and equipment. So just keep in mind, this is long-term debt. This is more than 1 year. So this is an example. Community bank issues a 60,000 60-day 5% note, or 2 issues a 60,000 60-day note that the bank discounts at 5%. Journalize the entries to record. Okay, so we're looking at both transactions. Okay, so let's take a look at this. So here's the solution: cash 60,000, received notes payable 60,000. Okay. So then we're going to pay it back, notes payable right here for 60,000, interest expense of 500. So total cash that will be paid is 60,500. So here's the second part. This is with the discount, so 50,000, and how we got the discount was 60,000 times 5% times 60 over 360. So we get $500. So cash of 59,500. And then interest expense of 500, and then the note payable of 60,000. So then notes payable of 60,000, and then cash paid was 60,000. Okay, so we received money and then we gave it back. So keep in mind, we're borrowing money and giving it back. So payroll liabilities. Payroll refers to the amount paid to employees for services they provided during the period. A company's payroll is important for the following reasons. Payroll and related payroll taxes significantly affect the net income of most companies. Payroll is subject to federal and state regulations. Good employee morale requires payroll to be paid timely and accurately. So salary usually refers to payment for managerial and administrative services. Salary is normally expressed in terms of a month or a year. Wages usually refer to payment for employee manual labor. The rate of wages is normally stated on an hourly or weekly basis. The salary or wage of an employee may be increased by bonuses, commissions, profit sharing, or cost of living adjustments. So companies engaged in interstate commerce must follow the Fair Labor Standards Act. This act, sometimes called the Federal Wage and Hour Law, it requires employers to pay a minimum rate of 1.5 times the regular rate for all hours worked in excess of 40 hours per week. You've also heard of double time for holidays. Exemptions are provided for executive, administrative, and supervisory positions. So here's an example. To illustrate, compute an employee's earnings and assume that John McGrath is a salesperson employed by McDermott Supply Company, $34 per hour, and any hours worked in excess of 40 hours per week are paid at 1.5 times the regular rate. So earnings at regular rate, 40 hours times 34 is $13.60, and then 2 hours above it, so 34 times 1.5, so $102. So total earnings will be $1,462. So the total earnings of an employee for a payroll period, including any overtime pay, are called gross pay. Pay from this amount is subtracted from one or more deductions to arrive at net pay. Net pay is the amount paid the employee. The deductions normally include the following: federal income taxes, state income taxes, local income taxes, medical insurance, pension contributions. Okay, so those are an example of the deductions. So income taxes, employers normally withhold a portion of employee earnings for payment of employees' federal income tax. Each employee authorizes the amount to be withheld by completing an employee's withholding allowance certificate called a W-4. So here's an example of a W-4 where you put the number of allowances you are claiming, typically right here, okay? And let's see, on the W-4, employee indicates the material marital status and the number of withholding allowances. A single employee may claim one withholding allowance. A married couple may claim an additional allowance for a spouse. An employee may also claim an allowance for each dependent other than a spouse, so kids or dependents. Each allowance reduces the federal income tax withheld from the employee's pay. The federal income tax withheld depends on each employee's gross pay and W-4 allowance. Withholding tables issued by the IRS are used to determine amounts to withhold. So FICA, employees are required to, by the Federal Insurance Contributions Act, to withhold a portion of the earnings of each employee. The FICA tax withheld contributes to the following two federal programs: Social Security, which provides payments for retirees, survivors, and disability insurance; Medicare, which provides health insurance for senior citizens. The amount withheld from each employee is based on the employee's earnings paid in the calendar year. The withholding tax rate and minimum earnings subject to tax are often revised by Congress. To simplify this chapter assumes the following rates. Assumes subject to tax: Social Security 6% on earnings, Medicare 1.5% on all earnings. So here's an example. So earnings subject to 6%, Social Security is 14, so 6% of that will be $87.72. Medicare will be 1.5 of the $14.62, so $21.93. So total FICA tax will be $109.65. So employees may choose to have additional amounts deducted from their gross pay, such as deductions for retirement, charitable contributions, life insurance. So gross earnings less payroll deductions equals net pay, sometimes called take-home pay. So here's an example, another example. Weekly deductions of $20, $5 for United Fund, and $257 federal income tax withheld. Net pay, so then we'll go through $87, $21.93, which we calculated, $257 income tax, $20 savings, and then United Fund total is $392. Those are the total deductions. Let's see, so then we subtract that from $1,462, and our net pay will be $1,069.40, okay? So employers' payroll taxes. Employers are subject to the following payroll taxes for amounts paid their employees. FICA tax, employers must match the employee's FICA tax contribution. Federal unemployment compensation tax, FUTA, this employer tax provides for temporary payments to those who become unemployed. State unemployment compensation tax, SUTA, this employer tax provides temporary payments to those who become unemployed. Okay, so here's a pictorial of this, or a graphic. Employee, Social Security, Medicare, federal withholding. Government is here. Employer business helps with Social Security, Medicare, federal FUTA. Here's FUTA and here's SUTA. Okay. Recording payroll. The payroll liabilities are normally recorded at the end of each payroll period. Okay, to illustrate the following data, so here's McDermott Supply. So here's what this will look like. Sales salaries expense $20,000, office salaries expense of $5,000. 6% of the 25 will be $1,500. 1.5% of the 25 is $370. Federal income tax payable will be $2,100. State income tax payable will be $550. And keep in mind, those are the percentages we saw earlier. And that's just multiplied by those values. And then retirement contributions payable is $1,200. Charitable contributions payable is $250. Salary payable, this is how much, this will be the take home, $19,025, okay? Recording payroll, employers must match employee Social Security and Medicare taxes. In addition, an employer must pay state and federal unemployment compensation taxes. So here's an example. So $1,500 is 6% of 25,000. 375 is 1.5% of 25,000, and 5.4% is unemployment up to 10,000, and then so 10,000 times 8% will be federal, or $80. So total payroll taxes will be $24.95. And here's how we journalize that, $24.95, and then we break it down to each of these categories. Keep in mind, each of these categories have to have their own account as well. So whenever they are paid, quarterly, monthly, however you decide to pay that, typically monthly. Okay, so I'm going to go ahead and stop right there, and I'll continue this video in part 2.